Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, March 11th, 2010. We begin today's report with a look at some U.S. fundamental data. We had the trade balance for the month of January come out, and it showed a narrowing of the trade deficit to 37.3 billion US dollars. While on the face of it, that seems to be a better than expected report. If you look into the figures, we see that the narrowing came as we had both exports and imports declining for the month, though imports dropped by a larger 1.7%. The U.S. imported the fewest volume of oil since February 1999, so that accounted for a large chunk of the decline in imports, though fewer purchases of foreign-made automobiles also played a role. Exports, meanwhile, were down $500 million to $142 billion for the month, as we had foreign demand for U.S. cars and airplanes decline during the month. The data increased risk aversion somewhat, as it implied that global trade was slowing somewhat to start the first quarter. In a second release, the number of Americans filing for unemployment benefits declined by 6,000 to 462,000 for the week ending March 6th. It was the second weekly drop in a row and could be a sign that the climb in weekly claims that we've seen the past 2 months may be abating. You can see on the chart to the right that we had a downtrend in claims starting around March of last year, but the last 2 months have seen the claims rising, though part of that was as a result of very severe weather during the last 2 months. So we'll see if the last 2 weeks in which claims have fallen back down continues and extends, as we need to see claims to go below the 450,000 level in order for there to be positive job growth. We were on the cusp of a positive non-farm payroll reading for February, but the severe weather did seem to turn it negative instead. If you take a look at the euro-dollar pair, we stay firmly within the range we have seen the past 5 sessions, with our support around 1.3550 and resistance just below the 1.37 level. We also have a downward sloping line of resistance if we connect our highs throughout most of February, and if we extend that down, we see that it comes up against the 1.37 level soon as well. Zooming this pair a little closer, we see that initially after the trade data came out with the better than expected reading, the euro gained on risk appetite, but then was sold off as traders and investors digested the data. However, we moved back up into our testing our resistance for the day around 136.85 by the end of the New York trading session. U.S. equities turned higher after opening the day a bit sharply lower. We paired those gains by mid-trading, and in the last hour of trading, we moved solidly into the green with gold and oil prices also rebounding for the day. Of course, the euro remains to be pressured by its lingering sovereign debt issues, so there's no catalyst right now for the pair to move above this 1.37 zone of resistance. Tomorrow we're going to have data on U.S. retail sales, so that could help to create some event risk, as a very positive reading would show that U.S. consumers are spending, and that could be beneficial to the global as well as the U.S. economic recovery. So that could have a positive influence on risk appetite and could push this pair above 1.37. However, we have only managed to move above this level shortly on March 3rd in the last 3 weeks, so this is a pretty strong level of resistance right now. We can see the swings in risk momentum much more clearly in the US dollar Canadian dollar pair, as we had an initial move in favor of the greenback following the release of US data. And as U.S. equities opened lower to start today's New York trading, we hit a high at 1.0320, which tested our high from Tuesday, and that was our resistance. And following that test, we saw the Canadian dollar gain as risk appetite and U.S. equities rallied. The Aussie US dollar, another one of our commodities that's closely linked to growth prospects for the world as well as commodity prices, fell to start today's session as we had a weaker than expected employment report from Australia. Then we rallied and fell back down at the beginning of New York trading. Today's action, therefore, looked like a correction to the rally we had seen in the previous two sessions. And if we plot our Fibonacci levels, we see that we tested the 61.8% area as a correction. Australia's labour force added fewer than expected 400 jobs in February when expectations had about 15,000 new jobs being created. While that's a pretty weak report on the face of it, if you look into the details, we saw that full-time work rose by 11,000, while part-time work fell by 11,000. So we did have a shift towards more full-time jobs at the expense of part-time jobs. Also, the unemployment rate was revised lower for the previous month to 5.2%, so we had an uptick in the unemployment rate to 5.3%. Now, the Australian economy has created close to 200,000 new jobs in the past 6 months, and today's report won't likely change much on the outlook for monetary policy for the RBA, which just recently pushed interest rates to 4.4%. It seems that the RBA will not be raising rates in April, with markets pricing in about a 33% chance that they would do so. So that may explain why the Aussie did not decline too much following the news and managed to pare its losses in New York trading. In a look at the pound dollar, we saw the pound rally in today's trading as we had a Bank of England inflation survey point to slightly higher inflation over the next 12 months. So we had that release around here and we rallied to the 1.5060 area until we met resistance, and we've tested that area 3 times now. If we start with yesterday's low, we managed to retrace now around 50%, a little bit more than 50% of this down move we had seen in the beginning of the week. In a final fundamental release, the Swiss National Bank reaffirmed its commitment to preventing excessive currency strength on Thursday, while it left its key interest rate changed at 0.25%. The S&B upped its 2010 growth and inflation forecasts as it now sees an expansion in the economy between of about 1.5% when before it had expected either 0.5 or 1% growth. Also, higher inflation would point to higher interest rates ahead, which would support the franc over the long term. Still, the inflation threat is not here in the short term, so that gives the Swiss National Bank more leeway to keep interest rates close to zero as the economy continues to recover. So here's a look at the Euro-Swiss franc pair, which had been declining the past several sessions, and following the news and a test of the 1.46 area, we rallied up to test 1.4630, but this sharp move in the wake of the S&B announcement was pared down, as it seems that traders and investors see the Swiss franc appreciating. So we'll see what the level is for the Swiss National Bank in which they decide to intervene in the currency markets. We have seen some interventions already, most recently back here in February 23rd, but also a much bigger intervention in February 5th when we had moved below the 1.4650 level. Originally, the firewall for the S&B had been the 1.50 level, but that was broken following our disruption in the Eurozone as a result of the Greece sovereign debt issues. Now let's take a look at the fundamental docket that will round out this week. Tonight we're going to get retail sales data from New Zealand as well as industrial production from Japan and from the Eurozone overnight. Tomorrow, Canada posts its employment change for the month of February at 7 a.m. Eastern. At 8:30, we get U.S. retail sales, which will be followed by the UMich consumer sentiment and U.S. business inventories. So the retail sales report should be the highlight of tomorrow's trading, with the employment report for Canada important to the Canadian dollar. So that will wrap it up for today's broadcast. For more news, videos, and technical analysis, please visit our site fxtimes.com. I want to thank you for watching and wish you good trading.